Hi investors, Joe here. It is time for another thrilling session of questions from my Patreon members. They provide the questions and I, based upon my 27 years of trading experience, attempt to give them some decent answers. Keep in mind this is not investment advice. I'm not a licensed or professional money manager. Trade at your own risk. Also keep in mind if you want to ask a question for me to answer, there's a 7-day free trial on my Patreon service. Link in the description below. I provide analysis of my portfolio and focus list. Wow, losing my voice. My portfolio and focus list every weekend and do some blog posts as well. Check that out in the description. All right, let's jump to some questions. Okay, first question. Patreon member Karthik wants me to share my thoughts on BBIO and NVO. All right, BridgeBio Pharma looks really good right now. This is the 1-year chart. We'll look at the weekly chart in just a minute here. But the 1-year chart, this was a power play. We had a prior uptrend. We had a cup handle, and handle on top of that here. Big breakout of 100%. That's your flagpole. And then this was the flag I tried to buy off the... I apologize. I bought this little pullback buy, and it wasn't ready for prime time, and it has built out another base. So here's your left side of your new base, and it looks like it's building the right side. It had a really nice earnings move. Came back in pretty hard, which... definitely don't want to see it come in so hard, although volume was pretty low, and appears to be bouncing off of this little double bottom formation. Technically, this is called a cap. If today is Monday, November 13th, if we see a nice bounce to the upside here in the morning, I would certainly be comfortable putting on a 1/3 or 1/2 position, then building out the position as it works its way up the right side. Let's jump to, this is stockcharts.com. Let's look at MarketSmith. BridgeBio Pharma, Transformative Medicines. Looks like they do have some revenue, sales, but no income. They are not profitable. Looking at the weekly, we got a big cup with handle here, and it has successfully filled the gap. Monthly chart, yeah, it's a recent IPO. So a biotech that's not making any money certainly is going to be more speculative, but biotechs can really run, and I like to have 1 or 2 biotechs in my portfolio most of the time. I jumped over to seekingalpha.com. They're my affiliate partner. There's a link for their service in the description below, and I believe there's a 7-day free trial on that. And I like to just, I get on here and I can look at the fundamentals and also read some news articles and analysis articles about it. BridgeBio bets, I don't know, that their medicine is a Pfizer spoiler. That's interesting. BridgeBio Pharma, a lot of paths to potential success. That sounds good. Then what we could do, of course, is read the summary and or read the article. Let's look at your other stock. And your other stock was NVO, Novo Nordisk. I never know how to pronounce that. It's a company from Denmark. It develops insulin, anti-diabetic drugs, and most specifically, it has one of the blockbuster obesity drugs, and they're making money hand over fist. Looking at the monthly, it's got a great long-term monthly chart. This is a stock that would be a good potential long-term hold if you can get into it. Sitting at 100, there's often lots of sellers lined up at big whole numbers like 100, 200, 500. So you might want to wait it out and let it gain control above the 100 mark. Little dividend, not too much to get excited about. Nice progression of annual earnings here. And let's look at the daily. It just split 2 for 1. 2 for 1 splits are pretty innocuous. When a stock splits 3 for 1, or especially 5 for 1, or heaven forbid 10 for 1, that often marks the top of that current run. But a 2 for 1 we don't need to get too concerned about. Just having some coffee there. The numbers are great. Let's see, earnings, nice acceleration of earnings, 39.54, 69%. Sales, 24.37, 39%. Gross margin, an insane 86%. They're 86 cents of every dollar they are pocketing, more or less. Now let's get a little surgical on the 1-year chart. We'll jump back to stock charts here. Yeah, I like this too. Prior uptrend, here's your cup, big breakout on earnings, and it's been oscillating here. And then we just had another breakout on earnings, has come back, has retested support. So I would be comfortable starting a little position on this one as well. Got a little bit of supply to deal with, and we could make a case for saying it's in a bit of a trend channel now. In fact, I can just draw this real quick. So if we call this a trend channel, it's not exactly perfect, but for a little bit of channel action, thinking about it in this way, it is a little bit elevated from that lower trend line. So if I was going to work into this stock, I might put on half a position here and then wait for it to curl down and get some sort of a spinning top doji like this, or some sort of bounce near this lower trend line. I like this Mark Minervini volatility contraction. See how the volatility is contracting? That's good. Let's just pop over to Seeking Alpha for 10 seconds. All right, let's see. NVO, Novo Nordisk. Here's some news items. They detail the heart benefits of their weight loss drug. They want approval for weight loss therapy. And some analysis. The price could still be justified. Novo Nordisk milks the obesity cash cow. How long will it last? Yeah, that is the question. And there are some competitors, Eli Lilly among them. So it would be good to read some of these articles and try to figure out, is this obesity cash cow going to last a few more months or a few more years? That is, as Shakespeare says, that is the question. Speaking of questions, let's go to the next Patreon question. Okay, let's see. Next question. This is from 𝗏𝗏𝐻𝑜𝑠huwa. Hope I pronounced that right. On Seeking Alpha, what ratings are you looking for when entering a stock from your focus list? And will an F valuation grade affect the way you trade? So let's take a look at that. Let me pull up. I was just looking at our focus list. One stock that I'm very interested in is FCFS, First Cash. This is a chain of very profitable pawn shops. We got a nice double bottom here. We've got a pennant with a little shakeout today. And if we look at, let's look at the month. And if we look at the monthly, we have a nice double bottom here with handle. So technically this stock is looking very sound. Now, I've told you guys before that I flip it. A lot of value-minded investors find stocks with good fundamentals and then they buy them and hope that they go up. I do the opposite. I find charts that are very strong, I buy them, and then I use the fundamentals to help me determine, is this something I want to quickly swing trade, or is this something I want to hold for long term? So in this case, here's FCFS. I just pulled it up on Seeking Alpha, and you can look at all sorts of different information, but let's go to ratings. So as a primarily swing trading, momentum swing trader, and occasional position trader, what I really want to see is high ratings in growth. High ratings in growth in FCFS, that's all. Let's call it First Cash. First Cash Holdings has a really good rating in growth. I want to see a good rating in momentum. It's got an A in momentum. Profitability is certainly nice, but not essential. Some biotechs do really well without, while they lose a ton of money. And I like to see a nice progression In this case, seeing it go from C plus to B is certainly good. Seeing it go from B minus to A minus is good. Now you said valuation. Let's go back. Will an F valuation grade affect the way you trade? Absolutely not. I don't want to sound flippant, but I really could care less about valuation. There's a big section in one of Mark Minervini's books, I can't remember if it's the first one or the second one, where he talks about stocks making spectacular moves once their PE ratio is already sky high, when their PE ratio is already triple digits, and people say they're overvalued. And yes, they are, but they stay overvalued for weeks or months. We have to remember, ultimately, the stock market is an auction, and the stocks go up if people are buying them. It's as simple as that. It has nothing to do with the value of the company. So value is one aspect, but when these things get momentum, it's like a snowball running downhill, and people climb all over themselves trying to get into it, regardless of valuation. So I ignore it, and many of the stocks that I frequent in and do well in have a D or F in valuation. This has a D minus. By traditional Warren Buffett valuation metrics, it's overbought. I always go back, I think about my dear friend Tilray. Here's the Tilray chart, TLRY. This was a marijuana company, still exists. But back in 2018, Tilray made a spectacular run from like 15 to 325. And it was insanely overvalued. It would have had an F in valuation that entire time. And if you had listened to the valuation grade, you would have missed that entire move. And I could go show you these over. Here's another borderline obscene example. This was FUV Arcimoto 3-wheeled electric vehicle, ran from like, I don't know, 15 or something to 700 plus, and it was spectacularly overvalued that entire time. They weren't even making any money, if I remember correctly. It was all on electric vehicle hype. So personally, I don't let valuation scare me away at all. I do like to glance at these, but where I spend most of my time is looking at the financials, looking at seeing if they do a dividend, and then just reading some of the news items and going and skimming the latest conference call or two, looking at the slideshow, investor presentation slideshow, and of course skimming or reading some of the analysis articles. And I don't do it all. I buy first and then I ask questions later. I will buy on technical analysis alone, and then I do my research to determine, like I said, how much leash to give the stock. Now, certainly if I've been watching a stock like Meta here, which has been basing for 3.5 months, then as I'm watching it, I'll start doing some of that research and be ready. And then Eaton also wanted to know thoughts on TW. Let's pull it up. Okay, Eaton, here is TradeWeb Markets. Looks like you found a good one. It's a little bit overextended. That's the short version. Let's see. Financial services industry ranking 82 out of 197. Profitable company with a nice trend of increasing annual profits. Little tiny dividend. That's nice to see. Relative strength is 95. That is good. I look at the three metrics: earnings, sales, and gross margins. Earnings are increasing. You're at 22% here. Sales are a little bit tepid at 14%. A gross margin has actually gone down a little bit. We want to see that go up. Technically, there's a lot to like. You're in the top 95% of performing stocks. We've got a prior uptrend. We've got a cup that formed like most stocks now. Big sell-off in 2022. You've got some nice stair-step action. As you can see now, it's overextended after the big earnings explosion. All-time highs at 100. Note that people often sell stocks at 100. So when a stock is approaching 100 for the first time, or the first time in quite a while, we always need to be ready for those sell orders to hit, what would we say, the docket. And here's stockcharts.com. We're looking at the right side of this base. Let's just draw in, let's draw some lines for ourselves here. All right, so here is on the 1 year chart. Here we have kind of a saucer base, compressed right side, little tiny pause pivot. The Brave could have bought out of that pivot. That's probably earnings right here. You got a big earnings move. You've got some normal oscillations. This is a nice tradable pivot here, but again, you'd be buying right in front of earnings. Now we've got this earnings explosion, and you've got a lockout rally here. Personally, I'd be thrilled to be in this. If I was not in it, I would not FOMO, and I would wait for it to retrace at least half of this move, and have it come back down to what I guess we can even call a high handle. I would let it come back in to at least give it back at least half of this move. Then as it starts to bounce back up, that's where I would pull the trigger. And I understand your question now. Would it scare me off if I saw an F for valuation? So no, not at all. What I care about is growth and momentum. And momentum has an A+ because I'm a momentum trader. I take on trades and I just try to ride the momentum for days, weeks, or months. It's kind of like being a surfer. That's a nice analogy. But I do like this. Seeking Alpha analysts are giving it a strong buy. Okay, William Sanchez, one of my most loyal Patreon members, says TLT monthly is horrendous. How does that influence equity? Okay, so here is TLT. This is the 20-year Treasury bond ETF, and as you can see, the price has been plummeting for the last 3 years. Let's go to the University of Google real quick. So there's an inverse relationship between interest rates and bond prices. If interest rates rise, investors will no longer prefer the lower fixed interest rate paid by a bond, resulting in a decline in its price. So in essence, this is the high. I'm certainly not an economy major or anything like that. But in simple terms, we want bond prices to be high and we want interest rates on bonds to be low. I've been showing my Patreon members this chart every week. This is the 1 year U.S. Treasury yield, but it's similar to the 20-year. So you can get over 5% on a virtually risk-free Treasury bill, and bonds are paying out similar high amounts. So it is tempting for millionaires with millions of dollars and companies and so forth to just invest in the bond market and the T-bill market instead of stocks because they're getting such a big payout risk-free. So we want to see the yields of bonds and T-bills to crash. We want to see the prices to go up. Hope I answered that halfway coherently. Okay, let's see. Lee Ann sent me 3 charts. So if you guys subscribe to stockcharts.com, you can send me charts to look at. So let's look at her charts. And if you want to subscribe to stockcharts.com, put my email address in the referral box. joe'sinvestmentexpress@gmail.com. No apostrophe. Let's find her charts. Okay, so on my dashboard, I have all of these chart lists of different industries and so forth, and I saved it into my lists here. Where is it? Lee Sullivan, Charts for Joe, right there. Okay, Leanne, let's look at this just from a technical perspective. So here's AIR. Here's the monthly. It has been flat for many years, but recently it broke out. Here you got a shoulder, head, shoulder, and it looks like it's entered stage 2. 94 relative strength line is making new highs, so that's really good. Now let's go back to your chart. And honestly, I think you've done really well here. Let me draw in a couple more lines. So here you've got a base, something like that. So this would have been a nice breakout buy right there. And you've got The second base here, I like how this base is longer. 1, 2, it's over 3 months long, which is really good. And it just made kind of a mellow move in between these bases. This is almost a base on base. I like how you're looking at the volume dying down, which we want to see the volume dry up and then explode when it moves to the upside, which it did. And so you've got this base breakout, and then it made this little cap up here, a little pause pivot of just a few days, and then you bought the high volume breakout. So that's really good breakout trading, and that will work really well in a bull market. Are we in a bull market yet? I want to say yes. It seems like it. We're just at the very beginning. Breakouts like this would have gotten you cut to ribbons in 2022, so you got to look at the body of evidence of what stocks are doing as a whole. Right now it seems like breakouts are working. I think this buy is really good. I think you even could have cheated here and bought right here. You got this buy off the bottom. So you got a prior uptrend. You've got a stock that meanders down to the 200-day on just decreasing volume, and then the institutions jumped in. They didn't even let it get to the 200, and then it printed an up day here, an up day here, and then right here when it crossed the 50-day, I probably, if I had been paying attention to it, I probably would have put on a 1/3 or even a half position. Yeah, because look, you could have done a 7% stop on that and still enable it to run all the way down to the 200-day. Now, as far as a stop where you're at now, yeah, so you could do, I'd probably do a stagger. I would probably do half right beneath your little pause pivot here, and then half beneath the 50-day. Let's look at the next one. Okay, you said you nailed COR, so let's look at COR last. Here's CPRT Copart. I know this one really well. Traded it many times. Long term looks fantastic. Does it ever? Let's just look. And here is the up and to the right 20-year chart. So this seems like the type of stock that if you can keep a piece longer term, this might be a potential multi-year hold where you manage the risk and sell off a piece at a profit and try to hold another piece at least until it stays above the 200-day. Now let's see what you did here. So looking at the weekly, you got a prior uptrend, you've got a cup, you got a double bottom within the cup. Here's a nice little handle here, and then a breakout, and then this new base is essentially a high handle. So you drew in your rectangular base. That looks good. Note that it's split 2 for 1. Two splits are actually to be feared. A lot of times stocks split at their peak. Now a 2-to-1 stock, 2-to-1 split is pretty innocuous. What you want to start getting nervous about is when you see a 3-to-1, or worse, a 5-to-1 or a 10-to-1. 5-to-1 or a 10-to-1 almost always mark the near-term tops, and it sure did with Google and Amazon and Tesla a couple years ago. But let's get back to your stock here. This stock was really telegraphing that it was going to break out. Look at all of the green bars here compared to the red bars. You've got accumulation, and most of the up days were on higher volume than the down days. That's a signal that institutions are slowly and quietly accumulating. And it ran off the bottom of its base here. It's really too bad that it didn't give you a longer handle. It would have been wonderful to see, a 5 or even 10-day handle, some sort of handle like this right here. That would have given us a much better pivot, so to speak, to trade off of. So you bought the gap up here. The gap up was on big volume. Minervini in general avoids gaps. This gap, however, was only about 1%. I certainly could forgive you for buying the gap. I think this is an aggressive play. When the market is hot, like in 2020, this would have been an awesome buy, and this would have been successful 95% of the time. Right now, it just really depends on the market. If the market continues to improve, which it seems to, then this probably will take off and run up 20% before its next new base and give you some price action like this. If the market stalls out, I suspect it'll just make a cap along here, and then when it breaks out of the cap, you could even add to the position. So I think it's a good buy. I think it's an aggressive buy. You really didn't have much of another option. I guess you could have used this as a little pause pivot and started your position right there. Overall, I like it. It's certainly aggressive, but I feel like we are on the verge, at least, of doing some aggressive buying. As far as putting in your stop, yeah, I just measured it out. This is a nice tight base, so you can give it a lot of wiggle room here. Here is your 10%. So I probably would do another stagger. I would probably put it one stop here at 46, one stop here at maybe 44 at the bottom of this bar, and then work up the lower end of the stagger. As the 50-day curls up, I would walk up that bottom of my stagger. Lastly, it's good to see that the 50-day is turning up. If the 50-day were turning down, it would be more likely to pull back. And then lastly, I would say you can also let fundamentals influence you just a little bit. This is not a perfect setup. It's a little bit aggressive, like I mentioned. But when you look at the stable nature of the fundamentals and how, I mean, we've got, actually we don't have a code 33, but they really have been consistently good for a large cap like this. That enables us to maybe get a little bit sloppy on fundamentals, in my opinion. A little bit sloppy in technicals. Sorry, I misspoke there. Let's look at your last one. Okay, this is COR, a medical wholesale drug suppliers. Industry ranking is 27 out of 197. That's really good. Nice looking 20-year chart. Most recently, you've got kind of a saucer pattern here, a little bit of a handle, firmly in stage 2. Relative strength is 92. That's a little, just a skosh low. My cutoff is generally 88. Very good money-making company. You got a dividend here. Got some pretty good numbers. Let's look now at the 1-year chart. All right, let's try to get surgical here. You got a prior uptrend. You've got a nice cup with handle. The right side is a little bit compressed here, but then you got this long handle. Here you have kind of a malformed bullish engulfing day. You want it to open down here below. But right here, the tick, the day after this bullish engulfing day, you honestly could have started a low cheat right there. The next good buy point would have been right here off of this handle. Broke out, squatted and reversed as so many stocks did in 2022. Now here's your buy point. I'm not thrilled with this buy point. Yeah, I see you're doing a pullback buy when it comes back to this handle here, but you didn't really get a bounce. Not only do I want to see on a pullback buy, not only do I want to see it pull back to the breakout point, the pivot point, but then I want to see a strong bounce. And so I feel like you rushed the gun here. I wouldn't have, that closed on the day's low. I would not have gotten in there. However, then you had a proper bullish engulfing day here. So then my buy point probably would have been right here. I would have gotten in at a higher price, but a less risky price. I really like how you sold on the way up. Sold a third for 8%. Sold a third for 13%. That's really great. I probably would have sold some more when it broke strongly through the 50-day right here. In hindsight, it just made another base, but sometimes they don't. Sometimes that's the end of the run and they fall apart. Let's see, the next base, you've got some institutional buying off of the 200-day. It's more likely to be successful if the 200-day is at a stronger ascent. However, it did certainly work in this case. So here's your left side, broke that trend line. Here, let me just draw that in. Here's your left side. Maybe let's do a little something. Having trouble getting a perfect trend line, but here's your left side. Broke the trend line here, retested, and then started its way up. This would have been a great low cheat. This is where you put on a 1/3 position, maybe even a quarter position. And then I see you mark the volatility contraction. Boy, you really are learning. Large, medium, small volatility contraction, strong bounce off of the 50-day, and it looks like you bought right here. You use this little pause pivot. Yeah, I like that buy a lot. I really do. Strong volume bounce off of the 50-day. There was a hammer and then a strong volume bounce to the upside the next day. I like that buy a lot. And now it has broken out of this cup. It's made a cap. Now it's breaking out of the cap. And you are looking really good. So if we draw a supply line right about here, it is sitting about, yeah, you're up about 3 or 4% from there. Now in a bear market, I certainly would be taking profits at 8 or 10%. If the market continues to improve, and it sure seems like it's going to, you might consider only selling a third instead of a half at 10%, or just raising your stop and trying to get those 20% gains. William O'Neill talks about in a bull market, the average stock will break out and run about 20 or 25%. Okay, and then Leanne also asked, CECO versus Lilly 20-year chart. Do you determine ahead of time how long you are planning to hold on to a position based on its 20-year chart chop sideways rather than 45% up to the right? So certainly I let that influence my opinion and my prediction of what's going to happen, but I will hold a stock as long as it's running. Sometimes a stock will slide sideways for 20 years and then make its epic run. Here's CECO. Yeah, and as we can see, it really has been sliding sideways. Although here's a big cup. One could argue maybe it's finally going into a stage 2. And let's look at Lilly. Eli Lilly making the obesity drug. Certainly this is the type of 20-year trend that we want to see. This one does have me a little concerned though, despite all the fundamental power that the stock has. It's getting a little parabolic. I really would rather see it. See, here's its prior trend line, and it's kind of jumped the trend line, and it's gotten, if we put that right in the middle, it's gotten a bit parabolic. So these both have their flaws, but certainly I will look at the 20-year chart and I will tell myself that yeah, Lilly is more likely to be the long-term hold. But like I said, when I buy a stock, I'm going to hold it until it either goes parabolic and I start selling off pieces, or it starts basing out, so I start selling off pieces, or if it reaches an arbitrary percentage, like if I'm selling most stocks at 10% in a bear market, I'll sell off a lot of it at 10%. Or of course, if it hits my stop, then I'm out. So that's a long-winded way of saying yes, I form an opinion of how long I'm going to hold it, but I let the stock determine what I'm going to do, not my opinion. My opinion is very often wrong. Okay, and then here's our last question. Karen asks, on which point do you differ from Minervini's style and why? That's a great question, Karen. So Mark Minervini is the greatest swing trader of all time. I have utmost respect for him. I've studied his 2 trading books and his mindset book in and out, been a member of MPA for a few years now, and I trade similarly to him in that I trade momentum. I trade stocks on the way up. I try to have very surgical entry points. I have tight stops of averaging about 5% or so. I buy high relative strength stocks, high RS stocks, generally above 90. Just looking at LMB here, and I draw lines of resistance and support, or as he says, supply lines, and then I buy when most of the supply has been cleared. So I have all of those things in common with Minervini. I have a few other tools in the toolbox that I use. Now he is he's a multi-millionaire without using these tools, so they certainly are unnecessary. One of them is I've studied Japanese candlesticks, and I like to use look for reversal candles to when I'm determining the end of an uptrend or downtrend. For example, here's a hammer candle. When you have a downtrend and it prints a hammer and then an up day the next day, that's generally a signal that the trend is changing. And here's another one on Netflix. You've got this uptrend. You've got this spinning top doji here with a crash after. This is almost a pattern called an abandoned baby. That definitely signals a near-term top. So, and Minervini never talks about Japanese candlesticks on MPA. He definitely, at least he doesn't talk about them. So I'm guessing he doesn't account for them in his trading. Another thing that I differ from is Minervini is not really big on chart patterns. He's all about looking for stocks with momentum that are clearing supply and giving tight tradable pivots. And I studied Thomas Bolkowski's Encyclopedia of Chart Patterns inside and out, as well as a few of his other books. And I really do like using patterns. For example, this double bottom here in AMD. And then lastly, Minervini doesn't really put a lot of emphasis on the 50-day and the 200-day moving average. He certainly is aware of them, but he seldom trades off of them. But I've listened to David Ryan quite a bit, who's a 3-time U.S. investing champion, and he does a lot of buying of bounces off the 50-day and the 200-day. And for example, the first time when a stock is in an uptrend, the first time it bounces off and an uptrending 50-day, it usually continues to the upside. And here we see that again here, as well as here and here. So we could have bought off the 50-day. And here's another example in BRBR where buying a bounce off of an uptrending 50-day would have worked really well. And the same goes for the 200-day. Here's BHVN. You've got an uptrending 200-day. You've got a downtrend flattening out. You get a hammer bouncing off of the 200-day and then an uptick. So I would be comfortable putting on a half position right there. Minervini would not buy until all of this supply would clear. He would probably have bought it. Maybe start a position right here and then go here. And here's another example, CAH. You've got a strong trending 200-day. You've got an uptrend that comes down and then bounces off the 200-day. This is institutions buying off the 200-day. It becomes kind of a self-fulfilling prophecy. David Ryan does that, and I've learned that from David Ryan. Mark Minervini does not generally buy these bounces off the 200-day. I'm sure there's some other differences. Those are the ones I can think of at the moment. But like I said, Minervini is the expert of short-term swing trading. I would study both of his trading books if you haven't. I guess, one other difference is I really try to hold certain positions long-term, multiple quarters, even multiple years. And Minervini rarely holds stocks for, generally for a quarter or so, occasionally for multiple quarters. I've been in Tesla, though, for example, since 2019, and Minervini doesn't have any long-term positions open on MPA, any positions for longer than a year. All right. I'm going to wrap it up there. Thanks, Patreon members, for your questions. Be sure to check out my Patreon in the description. If you're not a member, there's a 7-day free trial if you're interested in checking it out. And I look forward to answering your questions next time. Take care. Good luck in the market.